This is Asia Trade. I'm Shery in Tokyo.
And I'm Paul Allen in Sydney, where the market has just opened. Well, Fed Chair Jay Powell has told the Senate Banking Committee that there's no need to rush to lower interest rates with the US economy strong and the labour market not a source of significant inflationary pressure.
With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
Well, let's bring in our international economics and policy correspondent now, Michael McKee. So, Mike, tell us what was most of the committee interested in hearing from Powell.
Well, interestingly enough, Paul, they did not really focus on monetary policy at this hearing. A lot was on bank regulation and what the Fed thinks of the Basel III regulations that they were going to be implementing. The Fed Vice Chair for Supervision, Michael Barr, resigned a short time ago because he felt that the new president should be able to bring in his own person, and nobody knows exactly whether the Fed is going to proceed with that. So there was a lot of questions about that. There were questions about Fannie Mae and Freddie Mac and whether they should be privatized. It was a lot on regulatory issues, very little on monetary policy.
Yeah, how did market participants then take those very few comments when it came to monetary policy?
He didn't say anything new, so we got a little bit of a knee-jerk reaction with bond yields going higher because he's sort of confirming that they're not going to be moving anytime soon. But what they're really going to have to do is look at the data that comes in. Powell said they will watch and see what the effects of any policies from Donald Trump are, but he refused to comment on those policies themselves. So we are kind of no better off at this point in terms of what the Fed is going to do, and markets just have to try to price maybe when they think the Fed might move, but no indication from the chairman today.
All right, Bloomberg's international economics and policy correspondent Michael McKee there. Well, for more on what it means for rates, let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage. So, Garf, S&P pretty muted on Powell's reaction. I'm sure he's pleased about that. We saw yields tick up a little bit, but what's the market pricing now in terms of the rate trajectory for 2025, especially with an eye to CPI numbers tomorrow?
Well, the market's certain there's going to be one cut at the very least. It's more hedging its bets about will there be a second one. I think that's partly a function precisely of, the course from here is very murky indeed. Both, from the sort of existing trajectory we can see in the economic data, as in inflation has been cooling down, but that impetus has slowed somewhat, and was slowing. The slowing of the slowdown. The slowdown was looking less certain even before the US election and the advent of Donald Trump. And then the labor market was showing plenty of resilience. The most recent reports saw the unemployment rate edge lower. There's nothing there that says the US economy needs rate cuts straight away. In fact, there's some case still for saying that the Fed's last cut was a little bit too proactive on that front. So if if somehow Joe Biden was still president, if the previous, setup in the White House was the same, you would have policy uncertainty from the monetary policy side of things. But that's, of course, not the case. Now we've got Trump, we've got tariffs coming, though not for at least a month or so. And will there be exemptions? Will there be more tariffs? How is all that going to play out? By then, we might well also have more clarity on what's going on with the budget situation. So there's a lot of things where the Fed is in wait-and-see mode, as they say, and rates traders, people who are looking at what the Fed is going to do, they're also in wait-and-see mode. Like, yes, a rate cut is coming. We're not quite sure when. And by the time that next one comes along, well, then we might get more clarity as to how much more time it would be before there's another one. But there's a lot of uncertainty out there.
Yeah, which is why we're seeing a lot of movement elsewhere as well, right? Currency markets continuing to digest and just trade on headlines at this point. What will What will they be focusing on next?
Oh, well, currency markets will definitely be very strongly focused on the CPI numbers. If they show, if they come in to the downside, so we're seeing a bit more disinflation, that should send the US dollar lower. We're at an interesting potential inflection point here in that a lot of currencies fell quite strongly on Friday in the US session when Trump first said 25% tariffs are coming, and then they fell further at the start of the week when he said, yes, I'm going to sign tariffs on Monday, only to recover, and now they've been coming back up. It was a little bit of a strange picture. You come into your desk this morning in Asia and see, the euro was up strongly, the Aussie dollar was up strongly. Then you step back and you see what they've done is they've taken back almost all of those declines that occurred after Trump's initial 25% tariffs are coming idea. So we're in that limbo, partly because it's not until March 12, for the moment anyway, that those tariffs are going to come in. The recent history with Trump's decision to delay the moves on Canada and Mexico will have people thinking that even these general tariffs are a negotiating tactic, that there's no necessity that those will actually come into force. So until we're certain of that, currencies will stay away from that outside of fresh headlines. But CPI, that is something solid that traders can latch onto and say, okay, if it's accelerating, buy the dollar. If it's slowing down further, sell the dollar. At last, some headlines that they can trade with some level of certainty.
Yeah, the data doesn't lie, but we're getting a lot of Trump-inspired volatility, as you say, and is putting the Fed in wait-and-see mode. Is there anyone pricing in tightening for 2025?
Well, there are still some bets, on that front, and even those. One of the devilish things with tariffs is they're seen as being inflationary potentially in the short term. Over the longer term, the hit is seen as being to growth. So that's why there's also been a strong tendency to look for a flatter yield curve. 10-year yields are not reacting to the upside on the inflationary concerns about tariffs in the way that 2-year yields are. So that's adding to that murkiness. And as you say, even if we get data in the short term that gives you something solid to seize on, we're still always just one post on Truth Social or Twitter away from fresh volatility.
Garfield Reynolds, who leads the Markets Live coverage there with the latest on what to expect from markets trading in the coming weeks. Coming up on the Asia Trade, IDC previews Softbank's third quarter earnings with $1 billion net loss expected, and its big AI bets a key focus. BNP Paribas tells us how Trump's tariffs are impacting the Asian FX markets. Plus, an exclusive interview with Evolution Mining CEO Lawrie Conway as gold trades near record highs. Much more ahead. This is Bloomberg. We have breaking news. California's Insurance Commission planning to impose a $1 billion assessment on private insurers in order to support the FAIR plan. That would be the state's insurer of last resort. This is, of course, after the devastating Los Angeles wildfires, which destroyed more than 16,000 structures and resulted in insured losses of up to $75 billion. The assessment is necessary for the FAIR plan to continue paying claims to survivors of the fires. Insurance can pass up to half of the assessment onto their policy holders. The move is likely to deepen the insurance crisis that we're seeing in California already. So once again, California's Insurance Commission planning to impose a $1 billion assessment on private insurers to support the state's insurer of last resort. Right, and we continue to watch the feud between Sam Altman and Elon Musk. The OpenAI CEO saying a $97 billion takeover offer led by Musk is a business strategy that comes from a position of insecurity. Altman told us he remains confident in his company's technology and strategy despite the disruption from China's DeepSeek and the Musk bid.
Look, OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode.
You take it seriously at all? What do you think he's trying to drive at with this?
I think he's probably just trying to slow us down. He obviously is a competitor. He's working hard and he's raised a lot of money for XAI, and they're trying to compete with us from a technological perspective, from getting the product into the market. And I wish he would just compete by building a better product, but I think there's been a lot of tactics, many lawsuits, all sorts of other crazy stuff. Now this. And we'll try to just put our head down and keep working. Does it make it more difficult to move from that non-profit model to that for-profit model for OpenAI? We're not moving to a for-profit model. We're not sure we're going to do it all, but no matter what, the non-profit will continue to be extremely important. It will drive the mission. It will continue to exist. The board is looking at lots of options about how to best structure for this next phase, but the non-profit is not changing in anything or going anywhere. I mean, whether they did or didn't, they built a good model. Many people will distill from many other models. Again, I feel so confident about our research roadmap and also our product roadmap that, DeepSeek will do whatever DeepSeek's going to do. Other people do whatever they're going to do. And we're just going to try to build the best technology we can and get it into people's hands. And I think that's mostly going pretty well. Do you think Musk's approach then is from a position of insecurity about XAI? Probably his whole life is from a position of insecurity. I feel for the guy. You feel for him? I do, actually. I don't think he's a happy person. I do feel for him. Okay. Do you worry that he has this proximity to the president and that he can influence the decision-making of the U.S. presidency and policies around this agenda on AI? Not particularly. Maybe I should, but not particularly. I mean, I try to just wake up and think about how we're going to make our technology better.
OpenAI CEO Sam Altman there, speaking with our colleague Tom McKenzie at the Paris AI Action Summit. And Shery, Sam Altman throwing a bit of shade on Elon Musk there. But Elon Musk was busy with other things today at the Oval Office, talking about cutting waste in government, appearing with President Trump to talk about significantly reducing the size of government, laying people off, an edict that agencies can only hire one new employee for every 4 that they let go. He also pointed out that interest payments on US debt exceed the entire defence budget. We've also heard from Ken Griffin thanking Musk from the bottom of his heart. Let's hear what he had to say.
This is a man who slept on the floor of his factory to make sure Teslas got produced. He will do what it takes to win. We want people who are in Washington who will do what it takes to help the American taxpayer and the American people win.
This whole efficiency drive in the U.S. bureaucracy leading to even Fed Chair Powell commenting about how the Fed is not overstaffed but is overworked. Of course, we also heard from Ken Griffin talking about potentially other policies coming from the Trump administration, not just what Elon Musk is doing, but when it comes to tariffs, he really wasn't too happy. And he had pretty critical things to say about that move, especially given that, of course, he has also supported Nikki Haley's $5 million unsuccessful bid. He's actually contributed $5 million to that campaign, which was obviously unsuccessful. But take a listen to what he had to say, especially when it came to those tariffs.
And then, of course, with the pandemic came just spending on steroids by the U.S. government. Yep. And we haven't been in a reasoned world when it comes to federal policy on spending for 5 years now. So the big picture is Trump can't make the tax cuts he has on the table happen with the current level of profligate spending.
President Trump's meanwhile walked back a threat to withhold U.S. aid for Jordan after King Abdullah agreed to accept 2,000 sick children from Gaza. The two met at the White House with the king sidestepping questions about Trump's push to take over the Palestinian territory. So let's bring in Bloomberg News editor Michael Heath. Mike, it was a reasonably successful threat-free meeting. What were the key takeaways?
Yeah, well, the issue of the U.S. potentially curbing aid to Jordan sort of came off the agenda. The president said that he thinks the US is above that, and obviously the taking of the children from from Gaza their ill children, which Trump described as, a beautiful thing to do, which it is in many respects. But there was a bit of criticism of King Abdullah for not, again, rejecting this notion of transferring people from Gaza to another country, which he later did in a post sort of reiterating his stance. But there was another interesting point that sort of came out in Israel when they were discussing this whole transfer issue, that they were worried about it, potentially people from Gaza going to either Jordan or to Egypt, because what they feared is that you end up with such instability that they get another Lebanon on their border, as we've seen sort of with the Hezbollah conflict. So it looks like things may be sort of slowing down on that front in terms of pushing ahead with that. But it was a successful meeting, and what's sort of visible with President Trump is that if you can get yourself in front of him and put together a reasoned argument and do it diplomatically, and the King is an expert at that, he's outstanding, then it's quite possible to bring him around sort of more to your point of view as well. So I think that's one that everyone will take heed of.
We're also, of course, watching the Ukraine front and the war with Russia. Treasury Secretary Scott Bessent now expected to speak to Zelensky?
Yeah, that's right, Shery. Things seem to be really ramping up on that front. So the Treasury Secretary is there. He'll be the first US official to actually sort of be in Kiev. And the idea there is that President Zelensky and President Trump also are sort of keen for the US to get access to some of Ukraine's critical minerals, which it does have. It also has uranium and other reserves. And President Zelensky is more than happy for the US to have access to it, to help develop it. As he mentioned as well, Ukraine is going to need to do a lot of rebuilding. He's sort of trying to stress the whole business side, the whole opportunities side for the Trump administration in order to try and keep it as involved and engaged on Ukraine's side as he possibly can. But what's coming up is on Friday, the Munich Security Conference begins, and that's where there's going to be a lot of toing and froing on what may happen ahead, because obviously you've got people from Europe, from the US, and Ukraine there as well. Zelensky's meant to meet with the Vice President there too, and Trump's envoy is due to present some options for a peace plan as well. On the other side, we've seen Russia release a teacher that had been arrested, and obviously that's gladdened President Trump a lot. Russia basically has taken a lot of foreign people, charged them with various offences as sort of leverage in case of any spy swaps and that sort of thing. So that sort of has again warmed President Trump towards Russia. But Friday seems to be where we'll kick things off at the Munich agreement, at the Munich Security Conference, in terms of the rubber hitting the road and trying to find a peace deal.
All right, Bloomberg News editor Michael Heath there. We have more ahead on the Asia trade. This is Bloomberg. All right, let's take a look at some of the stocks that are moving here in Australia. We've got Evolution Mining, the gold miner, currently up a bit better than 1.6%. Net income for the first half coming in at $365 million. That was a big increase on last year, where it was $96 million, just a shade above that. The interim dividends, 7 cents per share. That was up from 2 cents per share. Now, the gold price is hovering around 2,900 an ounce at the moment. Put that in Aussie dollars, 4,600 an ounce. So Evolution doing very nicely out of that. Take a look at AGL as well, one of the big utility companies here. That's up by almost 2%. It did see a slide in profit. However, it's upgraded its profit guidance slightly for the full year. So AGL showing some gains there. Commonwealth Bank, one of the largest listed companies on the ASX. It really is the 900-pound gorilla of the index. That is slipping a little bit at the moment, announcing first half cash profit that did meet estimates, but signalling that the road ahead might be a little bit tougher. So Commonwealth off almost 0.9%. Let's get a bit more analysis on CBA's earnings. Bloomberg finance correspondent Harry Brumpton joins us now in Sydney. So Harry, not a bad set of numbers there, but as we look ahead to potential easing from the RBA, what's the road ahead? What's the second half look like for Commonwealth?
Yeah, it's heading into a more complicated picture, certainly. I mean, you mentioned that they're not the 900-pound gorilla, and it's mostly been, this share price appreciation that they've seen. It's up 40% over the last 12 months. And it was only 6 months ago they overtook BHP to become Australia's most valuable company on the ASX. And since then, the price has just continued to diverge. So shareholders love it. There's not a single analyst buy rating on it, though. So, I think, some people can definitely see the headwinds there. The headwinds would, clearly be the fact that as a bank, they take money in as deposits and lend money out. When the central bank starts lowering rates, that hurts their margins, and that's been a key area everyone's watched. What they've managed to do here quite well, and one of the reasons they have become so big and shareholders love them so much is because they're just this steady compounder. There's not these big swings and lumpy profits. And with this result, just a fraction above where the analysts were kind of expecting it to be, and that's mainly because they've managed to kind of keep a lid on arrears, even as the economy's more broadly has soured.
Just very quickly as well, we did have some commentary from Matt Common, the CEO. 30 seconds. What did he say? Not good.
Look, I mean, it's been very much like painting that economic outlook as just, look, things aren't great here. The consumer's hurting. There's light at the end of the tunnel, and that is what you would expect from a bank. I mean, they should be messaging, and they're kind of jawboning shareholders that the outlook is not hot from here.
All right, Bloomberg's finance correspondent for Australia and New Zealand, Harry Brumpton there. More ahead on the Asia trade. This is Bloomberg.
Softbank Group is expected to post its second net loss in about a year later today. That's after major investments in companies including Coupang and Arm Holdings dipped during the final quarter of 2024. Investors will also focus on how CEO Masayoshi Son plans to fund an investment in the Stargate AI project that could top $500 billion. Joining us now is Mario Morales, IDC Group Vice President of Enabling Technologies and Semiconductors. Mario, great to have you with us. As I just mentioned, I mean, we're expecting the earnings not to come out too rosy, but at the same time, they're just planning more and more spending on the AI infrastructure. First of all, what would you expect out of these results?
Well, I think that the net present value of the assets that they currently own will continue to make a gradual improvement. I think if you look at the company over the last 3 years, they've had pretty mixed results. A lot of it because they're making big bets in industries where there is a lot of innovation happening. There is a need for capital. And I think that as long as the capital markets continue to maintain their momentum, you're going to continue to see an opportunity for their portfolio to gain traction over time.
There's been, of course, concern about the rise of DeepSeek and just cheaper AI models and how that could potentially affect the need for really big and massive AI infrastructure that Softbank seems to be banking on. Is this going to be a problem long term?
Not necessarily. I think that DeepSeek was a positive for the industry as a whole. It's just not being seen yet because what I think you're seeing is the fact that now you can actually build more accurate and smaller models that smaller enterprises or mid-sized enterprises can take advantage of them. Not every company will need a frontier model, which is what OpenAI, Microsoft, Google, and everybody else is building. I think there's a need to segment these AI models a lot more. And I think DeepSeek was a good example of a momentum that we're going to continue to see, which is a shift to AI inferencing at the edge and at endpoints.
Questions inevitably turn, though, to the return on investment of some of this massive spending. What's a reasonable number to expect when it comes to profit?
Well, I think that right now, most companies they're all racing to try to get to the point where AI can be deployed in mass across all of these different vertical industries and segments of the market. We're still early days in that, so there's a lot of investment being made today in infrastructure, and you could see it with companies like NVIDIA and AMD and Broadcom on the chip side of things, but also with OpenAI and the amount of investment you're seeing there. So I still feel that there's another couple more years of investment that you need to have until the whole infrastructure is built and ready. And in the meantime, we have to continue to see how the business models are going to evolve as they begin to infuse AI across their business units. What's
a fair price for Softbank? Does it look like a buy to you at the moment?
Well, I don't evaluate companies. I'm an analyst, so I do a lot of research on how the technology is being deployed and where we expect the technology to end up going in the next couple of years. So I do believe that when I look at the type of portfolio that Softbank has, clearly they're picking a lot of the big winners. What I would love to see a lot more is actually trying to democratize AI to the point where it's not just for large companies like we're seeing today, but where it reaches every end of the world, where you can see any region have access to the capabilities that AI can bring to their economies, to their businesses.
When it comes to the earnings season itself, of course, we know, as you said, that potentially we will see that hit from parts of their business, including the valuation fall of ARM. How urgent is it that they settle their legal fights with, say, the likes of Qualcomm, and also at the same time to set the stage for potentially other deals? We're hearing now that Softbank could be ready to acquire Ampere Computing.
Yeah, well, I think that when you look at this, everyone's trying to get an edge, right? And ARM has been a very pervasive technology across smartphones and other market segments. And so the investment in that, even though it was back in 2016, it has returned a good investment for Softbank Group. But when you look over time, ARM is also still competing against Intel and AMD and NVIDIA, all these companies bringing a different architecture, chasing the same opportunity. So I think that in order for them to win, they have to continue to invest. The business model for ARM will continue to evolve as well, where traditionally they've been primarily an IP and royalty company, and that's how they've developed over the last 30 plus years. But now you're looking at ARM, and they're looking to raise royalty rates over time. And because of the level of technology that they're deploying, I think over the next 5 to 10 years, they will be capable of raising their royalties. But they're also trying unique business models that they have not done before, including finding a way to help support design activities in AI, and in some cases, even having to develop the chip themselves in order to go to market in that fashion. So I think this is a unique time where even successful companies like ARM and NVIDIA, they're all still evolving their business models in order to address the AI opportunity.
Mary, when it comes to non-AI assets, how do you assess SoftBank and the Vision Fund's other investments, Didi, Coupang? Also, we know that there were several Indian IPOs in the second quarter as well.
Well, some of these investments have come from the initial fund and now the second fund. In some cases, they've doubled down in some investments. But I think some of those will be a lot more mixed. I think that they're going to be driven more by what's happening at a macro level. So if the Chinese industry continues to be weaker, you're going to see Didi and some of the assets invested there be weak. I think the closer you get to infrastructure investments, I think the more likely you're going to see some increases in at least the value of these companies, just because of the level of investment that we're seeing, not just in the US with Stargate, but also in China and in other regions like India and Japan.
Mario Morales, good to have you with us, Group Vice President of Enabling Technologies and Semiconductors at IDC, as we await those results coming from SoftBank today. Staying with tech, we'll be also watching shares of Alibaba later after its ADRs rose on a report that the Chinese giant is working with Apple on AI. Let's get more with our reporter Annabelle Druller. So, Belle, this is according to the information, but what do we know so far about this potential tie-up?
This is a very interesting development for a lot of different reasons, but just thinking broad level, what we already know about the situation is that Apple has been losing market share in China. It's a very competitive market, and across the board as well, they're trying to roll out Apple Intelligence into their range of products. Of course, in China, they need to find a local partner, and throughout last year, there was a lot of speculation. Who would they be choosing in particular? And there was reports, for instance, that Apple was looking to Baidu, and they would be the pick to help them, again, roll out these AI features to the Chinese audience or users in China. But what the information is reporting is that that possible partnership with Baidu has run into snags, and so they've started to look for a new partner. Now it seems that perhaps, this is again according to their sources, but that Apple could, or rather Alibaba could be the one that they end up going with. So what we're hearing from the information is that both Alibaba and Apple have submitted to the Chinese AI features that they could end up rolling out to regulators in China. They do need to get approval from those regulators. And so it does also indicate, at least according to their reporting, that this sort of partnership is relatively progressed at this point. Of course, maybe people might say, you know, why didn't they consider DeepSeek, for instance, given how many shockwaves that player has caused just in the last couple of weeks? What we understand, again, from the information is that they're saying they did engage with DeepSeek. That's according to two people that had apparently direct knowledge of the matter. But essentially, Apple chose to go again with Alibaba, given it's got a lot more experience in this space. And they felt that perhaps the DeepSeek team, they lacked the manpower, they lacked the experience really required to roll this out at scale. So, yeah, I mean, we sort of saw that reaction overnight in the ADRs, but it's a very interesting development.
So, Annabelle, what's been the reaction from analysts to this?
Overall positive, you could say, Paul, really. I mean, we've been hearing from a couple of different ones, Evercore, Morgan Stanley, our Bloomberg intelligence team as well. So just thinking about the market reaction, we saw the ADRs. You can see that that's the last close, but they did rise up as much as 3% in the session. It has been a real stellar run for Alibaba throughout 2025 so far. I know it's the early innings, but it's still up nearly 27%, the stock in Hong Kong at least. But in terms of the reaction, well, Evercore is saying that this is not only a good thing for Alibaba, but it's also good for Apple, because iPhone sales, they do need to pick up in mainland China. They are losing ground there to other players like Huawei, for instance. They rolled out a trifold phone. I mean, the innovation cycle is very, very short in China. Morgan Stanley, they're saying that this, again, if it were confirmed, would be a positive both for Alibaba and for Apple's stock. And Bloomberg Intelligence as well, saying that it could allow Alibaba to tap into the more affluent iPhone user base for higher payable fees, and again, possibly boost their cloud revenue as well. So we'll, of course, continue to see how this one develops. But as I said, it's a very eye-catching possible partnership.
All right, Annabelle Drew is there in Hong Kong. The CEO of IBM has welcomed the disruption caused by Chinese AI startup DeepSeek. Arvind Krishna told us the reckoning over the costs of developing AI models will ultimately help fuel the adoption of the technology.
We've been on this point for a long time that you do not have to spend so much money to get these models. If you're willing to make fit-for-purpose models, we do believe that the cost should be in the millions and not in the hundreds of millions. And so how do you begin to distill models down to smaller sizes, get them unique for a purpose, and then run them at 2 to 3%? So 30 times cheaper than the big models, but as accurate and as good for a domain-specific task.
Do you think that, therefore, there could be a day of reckoning for some of these big tech companies spending billions and tens of billions, even $100 billion on CapEx spending plans these years?
That's probably beyond my ability to compute as a day of reckoning, but I can tell you that we're going to find that the usage is going to explode as the cost comes down. So maybe there's enough quantity increase that all of it maps out in the right way.
Yeah, you've always been a big supporter of open source models. And I just wonder in the case of DeepSeek whether that actually served as a reason for the disruption to take place. Would we not have seen a DeepSeek come to the market had there not been open source models?
No, I don't believe so. Because there are enough large models that people are building, not in the hundreds, but definitely in the tens. And it's hard to imagine that there's an ecosystem which doesn't have a large model to start from. Look, ideas tend to spread. This has been true for 2,000 years. People have written about this. Once there's an idea, it gets penned down, the idea spreads. Once an idea spreads, smart people everywhere can copy it.
Yeah. Let me ask you a question about regulation. I started off the interview asking you whether innovation can keep up with demand. Do you think regulation is actually keeping up with the innovation that we're seeing in artificial intelligence?
I'll actually go the other way around. Too much regulation early stifles innovation and then doesn't allow those companies and those nations where the regulation is heavy to succeed. We can always look at the example. I think that the EU is very good at lots of things, but sometimes the over-regulation is an inhibitor on innovation. And I think we should balance that.
IBM CEO Chairman Arvind Krishna speaking with Bloomberg's Jumana Brusetti. And these are some of the latest from the corporate front as well. CATL has filed for a jumbo listing in Hong Kong that could be the city's biggest stock offering in 4 years. Bloomberg's been told that the Chinese battery giant could raise $5 billion. CATL is a major supplier to Tesla, and its earnings rose as much as 20% last year as it tightened its grip on the global EV battery market. Online shopping giant Temu is said to be giving up substantial control of its Chinese supply chain in the face of President Trump's new tariffs. It's a move that threatens to drive up prices on the budget shopping app. Our sources say it's adopting what it calls a half-custody framework, where Temu only manages the online marketplace, leaving shipping to manufacturers. Goldman Sachs is ending its policy of not taking companies public that had all-white male boards. The bank previously would only take a company public in the U.S. or Western Europe if it included 2 diverse board members, one of whom was a woman. The decision comes as the Trump administration ramps up a campaign against DEI policies.
Okay, let's take a look at how we're tracking on markets at the moment. Things are kind of flat on the ASX right now. We do have a number of large movers, including Commonwealth Bank, AGL, Evolution, all of which reported earnings today. Futures for Japan, though, pointed in positive territory. It was a pretty quiet day for the S&P as well, following on from Jay Powell's testimony, in which he re-emphasised the need to be patient when it comes to the future trajectory of rates. S&P futures looking similarly becalmed at the moment. More ahead on the Asia trade. This is Bloomberg. Australia is moving to become a bigger player in the global energy transition, passing fresh tax breaks for firms involved in renewable hydrogen and critical minerals. It's working with the US to shore up supply chains for rare earths, which is vital to the green technology, as well as defence sectors. But Bloomberg New Energy Finance says the outcome of Australia's federal election this year could change the trajectory of the country's decarbonisation efforts. So for more on this, let's get to renewables analyst Tushna Antia. Tushna, Australia's targeting getting to 80% renewable energy penetration by 2030. But how's progress so far? Are we on track to get there?
Yes, so Australia has been notorious for seeing a boom and bust cycle when it comes to clean energy investment. Last year was a big year for investment in utility-scale solar and wind, as we saw $5.3 billion invested into the market. And this is an 80% uptick from the numbers that we saw in 2023. Like you mentioned, the federal government is targeting 82% renewable energy penetration by 2030. But at the moment, we only see about 36% of renewable generation in the market, in the national electricity market. So to close the gap, the government has introduced what it calls the Capacity Investment Scheme, and that essentially aims to double the amount of renewable capacity within a 7-year period. Now, this has really boosted investor confidence in the market and has especially helped utility-scale solar, of which we saw $2.3 billion invested last year, which was a near record high. So surely but slowly, the country is ticking towards its renewable energy target.
Could we expect that sort of boom for this year as well?
Yes, so we think 2025 is going to be a big year for 2 key reasons. Firstly, on the power side of things, we think that there will be 7 gigawatts of new solar, wind and storage capacity actually coming online this year. And to put this number into perspective, there was only about 2.5 gigawatts of capacity introduced in 2024. So a huge uptick. Now, policy clarity does play a key role in this, but so does the demand coming from big corporations like Rio Tinto, who is actually the largest corporate clean energy power procurer in Australia at the moment. Now, another reason why 2025 is going to be a big year for the industry is because we're expecting a lot more government support. According to our forecasts, we think that between the state and the federal governments, there will be 7 gigawatts of additional unfinanced renewables receiving government support. Now, if and when these projects do get commissioned and financed, it could represent an $18 billion opportunity for Australia. So quite a few big things to look forward to this year.
You mentioned earlier some of the policy uncertainty was seen in this space, and of course there's an election coming up. We don't know exactly when, but there could be a change in government. Could that change the picture?
Yeah, definitely. If the opposition Liberal Party do come into power, it could be a big wild card for Australia. Firstly, on the power side of things, the Liberals have started their political campaign by really pushing nuclear as a power source for Australia. But the long development timelines, the high costs, and the legal hurdles the nuclear industry would face could actually do more harm than good for Australia's power sector decarbonisation, especially in the near term. But on the broader, more decarbonisation side of things, Australia has reduced its emissions by 25% over the last 2 decades. The Liberals have said that they won't necessarily remove the 2050 net zero target, but we think that they will soften the interim target. So at the moment, Australia has a legislated target of 43% emission reductions. And at BNEF, we predict that the Liberals could soften this to about 35%. So there's a lot at stake if the opposition do come into power.
All right, BNF renewables analyst Krishna there. And stay tuned for another big interview out of Australia later on. Evolution Mining CEO Lawrie Conway is going to be joining us exclusively next hour to talk about their results, including more than doubling first half underlying profit, as well as a big jump in their capex outlook. Later, we're also in New Delhi for India Energy Week. The CEO of carbon recycler LanzaTech joins Insight to discuss the outlook for the global energy transition as President Trump tears up climate treaties and slashes spending. More ahead on the Asia trade. This is Bloomberg. Let's take a look at what's happening in the commodities space. Of course, as the markets still continue to digest President Trump's threat of tariffs on steel and aluminium at the moment. We've got aluminium prices looking a little bit softer. Australia has been singled out for criticism there by the Trump administration as well for the amount of aluminium it exports to the US. We've got a decline there of about 0.5% in the last trade. Iron ore prices still holding pretty steady, though, at about $106 per tonne. We've got a bit of softness in the materials space today on the ASX, though. That's sector down 0.4%. Oil's kind of hanging on to gains. It is a bit higher on supply concerns, but longer term, we did hear from the US Energy Information Administration. It sees the global oil surplus hitting $1 million barrels a day in 2026. And that's driven by non-OPEC and US production. That is up, Shery, from the 800,000 barrel a day surplus that was predicted just a month ago. So perhaps some softness in the future for the oil price.
Yeah, and of course, we continue to watch the oil markets given, of course, tariff concerns as well. Other stories that we're following, the European Union has promised to respond after the U.S. imposed 25% tariffs on steel and aluminum imports. The EU has prepared a list of American goods to hit with retaliatory tariffs, with European Commission President Ursula von der Leyen saying that unjustified tariffs will not go unanswered. EU trade ministers will hold a video call later today to discuss their next steps. Automakers in the U.S., including General Motors and Ford, are lobbying against ending EV tax credits. Bloomberg has learned that they're pushing for a gradual phase-out over several years if the Trump administration moves to cut them. Car makers say that a prolonged phase-out would give them time to drive battery and EV costs down.
All right, let's take a look at how we're doing in Australia after the first hour of trade. The market kind of flat at the moment, although we have seen the biggest stock on the index, Commonwealth Bank, turn positive in the last few moments. It's now up by 0.2%. Cash profit for the first half coming in line with estimates. Looking ahead to the open in Japan at the top of the hour, we've got Nikkei futures positioned higher by about 0.8%. S&P futures pretty flat at the moment. It was a quiet day for US markets off the back of Jay Powell's testimony. All right, stay with us. We will have the market open in Seoul and Tokyo up next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens ahead of U.S. inflation data that's expected to be a little bit mixed. Of course, we continue to contend also with President Trump's tariffs. And already, Paul, we heard from Chair Powell in his Senate testimony talking about still a solid U.S. economy.
Yeah, we'll hear from Jay Powell in just a moment. Markets are pretty muted off the back of his comments, but in terms of inflation numbers, we're going to get some out of India later on today as well, which could put a little bit more appreciation for the rupee, which is backing away from some of those record lows. We'll have Japan machine orders as well a little bit later on, Shery.
Yeah, plenty of data for markets to digest today, especially as Japan is coming back from a holiday. In the previous session on Monday, the Nikkei virtually ended flat because it was still digesting that amicable President Trump and Prime Minister Ishiba summit, but at the same time, concerns about how tariffs would affect the Japanese economy. We heard from the finance minister this morning talking about how Japan would be mulling a reaction depending on those impacts from the tariffs that the U.S. is imposing. But it's really about those key sectors, right, like automakers that we're watching. Also today, we do have earnings from Softbank that's expected to announce a net loss in the last quarter. The Japanese yen weakening against the U.S. dollar slightly at that 152 level. What we're watching is also what's happening to yields, because we have seen the 10-year JGB yield now at the highest level in 14 years, because it's not only about digesting geopolitical concerns, but also about what the Bank of Japan is doing. And it seems that markets are considering expecting the BOJ to continue on its tightening path. Take a look at how the Kospi is coming online as well, another market that will be battered by tariffs, especially given that cars and chips are two of their biggest exports. President Trump has talked about coming out with a number when it comes to applying tariffs on those sectors. The Kospi under pressure, 0.2%, while the Korean won is unchanged, but we already saw that significant pressure in the previous session as well, Paul.
Right, let's take a look at how we're tracking here in Australia. Market been open for just over an hour now. We're seeing the market pretty flat at the moment, although the biggest stock on it, Commonwealth Bank, has now moved into positive territory after a sluggish start. First half results coming in line with estimates. A very healthy dividend from Australia's largest listed entity of $2.25 per share. But the broader ASX flat right now. We've seen a little bit of appreciation in the Aussie dollar as well, just below 63 cents now. Yields moved a little bit higher on Jay Powell's remarks. Just to summarise, he's saying that the Fed is going to be patient when it comes to rates. And as Shery mentioned, we do have US CPI numbers coming out tomorrow. They're expected to stay steady at 2.9%. Once you strip out food and energy, we could see inflation move a little bit lower to 3.1%. But let's have a listen to the man of the hour, Jay Powell, hear what he had to say in his testimony.
With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
All right, let's get some more perspective on markets now. Joining us now is Kaminski, Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. Katie, we just heard from Jay Powell there, emphasising patience. It's a message we've heard before, but can we talk about perhaps what he isn't saying in terms of the path ahead? I mean, obviously there is a risk from fiscal policy here around inflation. How do you weigh this risk?
This is a good point, because what we've been really trying to parse out is the technical signals in fixed income have remained short, which would suggest that rates should be higher for longer. And most people think that it's going to take some time and some ammunition in terms of macro data for the Fed to act again in terms of cutting rates. And I just have to say that given the amount of speculation about changes in policy as well as tariffs and fiscal spending, that is adding yet another level of complexity for what will happen with interest rates in the U.S. So as a result, we're still seeing short signals suggesting higher for longer now, but that's definitely could change if data would change in the short term.
Can you tell us a little bit about your strategy in this environment of White House-inspired volatility? Do you try to trade around it, or do you pick a few solid names and just get long?
This is a good point, because I think one of the biggest themes that we've seen is that realized volatility has actually been relatively low for the type of positioning that we've seen. So although you're seeing a lot of uncertainty in headlines, you're actually seeing that movement has been relatively muted. So I think it's really a time to try and figure out what is the second order effects of these policies that we haven't seen yet in market moves, and try and position yourself in different assets that might actually benefit from an actual decision on some of these policy decisions. So I think commodities might be a good example there, trying to sort of position in the commodity markets before they break out, and other sort of trades, especially within the equity sector, leaning in specific sectors which might benefit from disparate import-output costs going forward.
Do you also get out of some of those calls? For example, if we do see a weakening of U.S. consumption because of these tariffs, would you be really trying to phase out some of those consumer names, perhaps some of those domestic names, and where would you put that money instead?
I mean, this is a very good point, because right now the big question is between whether or not the short-term potential for an impact on inflation is going to have a short-term impact on the consumer and thus have a differential impact across different sectors. The longer-term question is whether or not we're going to see inflation baked into more long-term cash flows. So really you'd have to play that in different ways. One would be sort of looking for the right sectors and how those would react to tariffs and changes in policy. The longer game would really be thinking about how inflation might change with all the different initiatives right now in the new administration.
What are you seeing across Asia right now? Because we have seen really the underperformance against especially big tech in the U.S. Could we see some more value in some of these names across the Asian markets?
Well, this is a really good question, because one of the key themes that we have seen from the trend perspective this month is that things that haven't been the key theme have been sticking out. So, for example, Hong Kong and Hang Seng Enterprises is something that has really stuck out for us as breaking out from previous trends. That being said, we have seen a dip in many of the Asian equities that we trade, in the sense that, you know, they are reacting to this, to the knowledge about the potential for tariffs. So there are opportunity sets out there, but it's not a one-to-one. I mean, you just mentioned the Korean won. That is something that has taken a pretty large hit with recent movements. So there may also be buying opportunities for certain currencies that may have been overextended, depending on how far tariffs and other measures go.
Katie, I just want to put to you our Bloomberg question of the day, which assumes gold's going past $3,000 an ounce. Is this a trade you're involved in? And how far beyond $3,000 an ounce do you think gold could rise?
Oh, this is a great question. I mean, gold has been one of the biggest winners year to date, and I find it very fascinating because gold in this sense seems to be much of a safe haven trade in a world where we're not sure what the next step is. And this has actually been something that we've been following as early last year. So it seems that it's being seen as sort of the trade as a hedge against inflation and other sort of changes in policy. So I do think you could continue to see people buying gold with this idea that it is the safe haven when you're not sure if bonds are going to be that safe haven or if the US dollar could be potentially overextended, for example.
Katie Kaminski, good to have you with us, Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. And take a look at some of those names that we're watching in today's trading session. Of course, automakers, as we got those tariffs as well from President Trump, 25% on steel and aluminum. We're also expecting Softbank's earnings today, and they're expected to report a net loss for the last quarter. We're talking about $1 billion, according to the average estimate. And some analysts are really looking at perhaps some of those shares of Coupang and Didi where Vision Fund is invested, because they have given up some of their gains, and that could cost Softbank in this latest earnings. We're also watching for those automakers that I mentioned earlier, and you can see the downside broadly as we have seen those steel and aluminum tariffs expected to come into effect in March. And of course, the conversations are ongoing between Mexico, Canada, and the U.S. as well.
We've had a lot of earnings out of Australia this morning. Just to briefly recap for you, start at the bottom of your screen there. Commonwealth Bank has just turned positive after a sluggish start. Now up about 1/3%. Profit for the first half did meet estimates, coming in at 5.13 billion Australian dollars. Some concerns about the path ahead, as the RBA is widely expected to start cutting rates in the second half. However, take a look at the interim dividend, $2.25 a share. Still a pretty good return for shareholders there. AGL Energy, meanwhile, one of the big utility companies here, did upgrade its profit guidance slightly for the full year, even though first half profits slipped. So we're seeing a bit of a pop in that stock, better by 2%. Evolution Mining, though, really capitalising on this big run-up in the gold price. And when you put that gold price in Aussie dollars, it gets even more impressive. Net profit almost quadrupling to a record 365 million. That's up from 97 million same time a year ago. The dividend more than tripled, although it's only 7 cents per share. OK, and stay tuned for a big interview coming up later. We'll be talking to the Evolution Mining CEO, Lawrie Conway, going to be joining us exclusively later this hour to talk about those results, including that more than tripling of the first half underlying profit. There's a big jump in their capex outlook as well. Stay tuned for that conversation. More ahead on the Asia trade. This is Bloomberg.
It's not a complex thing to do. And with the United States being in control of that piece of land, a fairly large piece of land, you can have stability in the Middle East for the first time. And the Palestinians, or the people that live now in Gaza, will be living beautifully in another location.
President Trump there reiterating his desire for the US to take ownership of Gaza. The president also walked back a threat to withhold US aid for Jordan after King Abdullah agreed to accept 2,006 children from Gaza. Now, the two met at the White House. The king sidestepped questions about Trump's push to take over the Palestinian territory. Let's bring in Bloomberg News editor Michael Heath. Michael, there seems to be a familiar cycle here. President Trump talks about taking over Gaza. Officials walk it back. He says it again. How's the Arab world responding to this?
Not particularly positively, certainly at least publicly, Paul. So while King Abdullah didn't directly address it when he was outside the White House, he copped a bit of criticism for that, and later, sort of reiterated his position in a post on social media. The general sense is, and I think the Arab world feels like it needs to be united here. Jordan is not a powerful country as such, though the monarchy is usually pretty well respected in the West as a deal maker and that sort of thing. Most importantly for Abdullah, he managed to. Trump agreed that they wouldn't do anything on aid in terms of trying to pressure Jordan in particular, but Egypt as well. But generally speaking, they feel like if they remain united here, it'll sort of eventually become clear to President Trump that this is sort of not really feasible, which, for various reasons we've discussed over the last few days, that's the case. And we've also got this problem going on in Israel that the ceasefire that everyone's worked so hard on seems to be it's on very thin ice now with the Palestinians having Hamas having said that it will. That it may suspend the release of hostages. It then walked that back. President Trump also said that all hostages should be released by 12 o'clock on Saturday. Prime Minister Netanyahu backed that up, though it's not clear whether he's saying all hostages or the ones they've agreed on. And Israel's mobilised its forces. So, if everything went wrong, we could find ourselves back in war here. So, it's a really, really sensitive time, as always, in the Middle East.
And of course, we know that there's a whole different thing happening on the Ukraine front as well. The Treasury Secretary headed there.
Yeah, that's right, Shery. The Treasury Secretary's there. He's going to be the first cabinet official from the Trump administration to actually go to Kiev and to meet with President Zelensky there. And basically, he's there to try and work out what the US can do in terms of Ukraine's its mineral resources, which President Zelensky is very keen for the US to become involved in, and it has quite large. It has reserves of uranium and other critical minerals that would be appealing to the US. And for President Zelensky, he's very, very eager to do this because part of the peace deal that everyone's looking for Ukraine, the critical element is some sort of security guarantee. Now, Europe's prepared to provide that, but President Zelensky understands that he needs US involvement in it. It's only the US, so whether that's through NATO or a bilateral agreement with the US, only that is going to ensure that Russia doesn't, if they get some sort of peace agreement, that Russia doesn't pause, rearm and come again at them. The US or NATO is enough to keep Russia behind its borders. So it's a very interesting time there. And President Zelensky has also made clear to the US that in the reconstruction of Ukraine, he'd be very keen for US firms to be involved. So all these sort of commercial side of things, I think, would be quite appealing to the Trump administration. On the other side, we've seen Russia release a teacher who'd been arrested for having medical marijuana. And again, that's sort of a show of good faith by Russia and obviously has warmed President Trump, who's always fairly positive towards Russia as well. So the big issue then is on Friday, we've got this Munich Security Conference. A lot of different parties potentially involved in Ukraine will be able to meet there, including Zelensky with Vice President Vance. So I think that's where we're going to really start to see some movement.
Bloomberg News editor Michael Heath there. And other stories that we're following right now, President Trump also directing agencies to comply with orders for job cuts led by Elon Musk's so-called Department of Government Efficiency. A White House fact sheet seen by Bloomberg shows that agencies will be permitted to hire no more than one employee for every 4 workers leaving. Musk made a rare appearance in the Oval Office to defend his approach, which has involved obtaining access to sensitive computer systems and employee data.
Transparency is what builds trust, not simply somebody asserting trust. So not somebody saying they're trustworthy, but transparency, so you can see everything that's going on. And then you can see, am I doing something that benefits one of my companies or not? It's totally obvious.
And if we thought that, we would not let him do that segment or look in that area if we thought there was a lack of transparency or a conflict of interest.
The European Union has promised to respond after the U.S. imposed 25% tariffs on steel and aluminum imports. The EU has prepared a list of American goods to hit with retaliatory tariffs, with European Commission President Ursula von der Leyen saying that unjustified tariffs will not go unanswered. EU trade ministers will hold a video call later today to discuss their next steps. Automakers in the U.S., including General Motors and Ford, are lobbying against ending EV tax credits. Bloomberg has learned that they're pushing for a gradual phase-out over several years if the Trump administration moves to cut them. Car makers say that a prolonged phase-out would give them time to drive battery and EV costs down. We have more ahead. This is Bloomberg. We'll be watching shares of Alibaba later after its ADRs rose on a report that the Chinese giant is working with Apple on AI. Let's get more with our reporter Annabelle Drewlers. Belle, we know that this is according to the information, but how significant would this be?
This would be very significant, really, at least from Alibaba's perspective. Just generally, we know that Apple is rolling out these Apple Intelligence features. In China, it needs to find a local partner. Last year, we were thinking that perhaps Baidu could be that choice. But what we're understanding is that, at least from the information's reporting, that has sort of stalled. They started to look for a new partner instead. Now we're hearing that Alibaba, is the one that they're working with. And actually, they've reached the point Apple and Alibaba that they've actually submitted Chinese AI features to regulators for approval. So it indicates that there has been significant progress. Of course, why not DeepSeek, given how much attention it's just caused over the last few weeks? And again, according to the information, Apple did work with DeepSeek and have these conversations, but they just felt there wasn't enough manpower and experience to roll out AI at scale. So that's that part of the story, according to the information. Market reaction as well, we're getting that. We saw the ADRs, for instance, rising on Wall Street overnight. We'll track, of course, how it opens in Hong Kong later this morning. But analysts are generally positive, not just from the perspective of Apple. This can help them in that key Chinese market where they're losing market share, but also, of course, for Alibaba to access higher paying users as well.
All right, Annabelle Drill is there. The property crisis, meanwhile, that's hobbled China's economy and created a near $160 billion pile of distressed debt, is getting worse. Risks continue to grow as Chinese authorities are forced into the first mainland rescue, and major Hong Kong developer New World's bonds sink into distress. Let's bring in Bloomberg's executive editor for Greater China, John Liu, for more on today's Big Take. John, this issue has been festering for years now. Are we continuing to see signs of contagion, and can it be contained?
Well, we actually saw a bit of recovery at the end of last year. You'll remember all of these stimulus measures that were announced just before the October holiday. We had lots of restrictions on home buying removed. We had mortgage rates lowered. And so there was a pickup in home sales. But that, it seems like, is starting to stumble. The latest numbers that we got for January show that, again, home sales were falling. And that is not helping Vanke's situation. They have about 5 billion yuan of debt of bonds they need to repay this month. They have about 35 billion yuan they need to repay the rest of the year. And if they're not able to sell homes, the question becomes, where are they going to get the money to pay off that debt?
How did we get here? Because, as you said, we had seen signs of recovery. We had seen Beijing trying to put in place more supportive property measures. But at the same time, just these big developers like Vanke now that were once a symbol of strength in this sector are faltering.
I mean, the fundamental issue here is people are not buying homes at the rate that they were buying them in 2018, 2019, and earlier. The issue here is these developers borrowed lots of money on the assumption that they would be able to build these homes and sell them. That is not coming true. We've had prices falling for the better part of 3 years, and in a market where prices are falling, people are going to be hesitant about putting their money into a new home. We've also had protests where people paid for a new home, the developer went under or wasn't able to finance the construction of that home, and there was this danger that people were going to just lose all their money and never get that home. And so all of these stories, all of these issues have put a lot of pessimism in the market, and people are staying on the sidelines.
John, you mentioned efforts from regulators earlier. I just want to look at one of the comments from the story. Co-founder of Forest Capital Hong Kong says China's regulatory efforts are like applying a Band-Aid to a knife wound, and they always come at the worst moment. There's some more proactive action required here.
I think it's really important to note when we're discussing the difference between Evergrande, for example, and Vanke, and that important difference, I think, is the background, the context. The economy today is in a much weaker position than it was when Evergrande was starting to go through its problems. There's a lot more concern in Beijing about the outlook, and we have this threat of tariffs from the United States under this new Trump administration. So all that added together, I think the level of concern when it comes to Vanke is much higher, and I think as a result, the government has shown it is willing to take bigger steps to do more in terms of policy, to do more in terms of helping to try and stabilize the situation.
All right, Bloomberg's executive editor for the Greater China region, John Liu, there on China's ongoing property crisis. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how some of the currencies right now that we're following are trading, because we continue to watch the euro. This, of course, as they've now threatened retaliatory measures against President Trump's tariffs. We have seen that pressure on the euro for quite some time. This, as the dollar is also slightly drifting lower. We have seen incredible strength, but at the same time really being whipsawed by comments from Chair Powell when it comes to the pace of rate cuts. Currency trading, of course, has become very active and profitable. Trading firms, banks like Wells Fargo and Citigroup expanding their currency trading teams. We'll be watching EM currencies because they've been pretty resilient despite, of course, the tariff concerns. The rupee especially saw this huge rally yesterday, the biggest in more than 2 years. Sources now saying that the Reserve Bank of India intervened in the markets. A little bit surprising given that traders were not expecting the central bank to be this active, but we have seen their tolerance for the weakness of the rupee now being broken a little bit. But let's get more insights with Parisha Saimbi, Global Markets, Foreign Exchange and Local Market Strategist for Asia at BNP Paribas. Great to have you with us. So right now, the calculation seems to be that we will continue to see a stronger dollar if the Fed does not cut rates faster or at an expected pace. Given what we heard from Chair Powell and, of course, the upcoming U.S. CPI numbers, how are you setting up?
Sure, yes. So I think listening to Powell overnight, he certainly reiterated a message that we heard at the January press conference at the FOMC meeting. So for us, it hasn't changed our base case. We remain quite comfortable of the view that the Fed will keep policy rates on hold through the course of this year until the middle part of 2026. We do see balanced risks around that, though. Certainly, if we saw fewer tariffs being announced from the U.S. administration, then perhaps then they could move towards rate cuts. But equally, if the economy moves away from that softer landing and we see continued strong labour market data, then we do think that the risks of rate hikes certainly could rise. But in terms of markets, we do think medium term that the dollar can continue to strengthen as we see further delivery and implementation of tariff policies from the US. And with the Fed keeping rates on hold and other central banks moving to cut, we think widening rate differentials will also be a support for the dollar.
So who are the most vulnerable, especially across Asian markets, when it comes to dollar strength?
So I think, firstly, it's a question of rate differentials and where do we see those rate cuts. And we do think that there will be kind of 2 to 3 rate cuts, broadly speaking, across the Asian central banks. But I think the second and more important factor for markets will be the tariff policies and which countries may be targeted or vulnerable. And in our view, we do think that China will see further tariffs. But also we see that Taiwan, South Korea, Thailand will be some of the more particularly vulnerable currencies if we do see tariff policies, whether that's on them directly or just indirectly, given their sensitivity to the renminbi.
Well, if we take a look at just China, you mentioned the renminbi there, the yuan, very weak at the moment. How far do you think policymakers will be willing to let it continue weaken? Where's the floor?
So we think that the move in dollar China can rise towards around 745, 750 over the course of this year. And that's if we do see our base case, which is for a further 15 percentage points of increase of tariffs on China. But ultimately, we do think that they will wait and keep the fixing on hold until we see the implementation of them. So we may have to wait a little bit longer before we see that move, but ultimately we do think that the path is higher. That being said, that's not a very aggressive move in all circumstances, and the reason is ultimately if we look at the renminbi on a real effective exchange rate basis, it's already trading at extremely low levels. So we don't think that there is a need for an excessive move higher in dollar China over the course of this year.
Well, one market that's sensitive to what's happening in China is obviously Australia, where I am. And you mentioned central bank decisions might have an impact on currency valuations as well. Well, we've got the RBA next week. We might see the first easing that we've seen from the Reserve Bank or here that we've seen for quite some time. Given that the Aussie's a commodity currency as well, what's the path of least resistance for the Australian dollar?
So certainly there will be pressures on the Australian dollar to the downside if we do see delivery of rate cuts. But if we think about the broader scope, Aussie is a high beta currency, so it will be sensitive to risk sentiment. And if we do see these more protectionist policies, that is something that could potentially weigh on risky assets more broadly and consequently then for Aussie as well. That being said, we do think that Aussie could perform slightly better than some of the other higher beta peers because we don't think that the impact of tariffs will be as severe for Australia. We did some analysis and we found that actually a lot of the raw materials that Australia exports to China are mostly for their domestic consumption and are not necessarily for re-exporting on or as part of other goods that China exports to the rest of the world. So actually, we think compared to the likes of CAD, for example, we think that Aussie could outperform.
When it comes to being insulated from those tariffs, I think India would also be one of them. You say that they are going to be the ones who underperform the least in your notes, and yet we actually saw the Reserve Bank of India being forced to intervene in the markets. What do you think is the rationale here?
So I think we have to remember that there's been a lot of pressure on the rupee over the past few months, particularly given the portfolio outflows that we've seen both on the equity and the debt side. And that has only continued through the month of January. While the RBI have been intervening to stem the pace of that move, ultimately those pressures still remain. Growth has also been slowing, and that's also added to those pressures. And the RBI, we've had a change in governor and we've had a rate cut from them, so markets have had to adjust to this new dynamic. Going forward, I think near term, we do still see some pressures for dollar INR to continue heading a little bit higher, especially given that the RBI have used a significant amount of their reserves over the course of the last year that might limit them from being able to intervene aggressively on a sustained basis going forward. And if those outflows continue, that will act as another headwind still. That being said, there is a lot of bearish positioning that has been built up in the INR. According to our global FX positioning tracker, we have a metric that gives us a score on a plus minus 50 scale. And for the INR, it's currently at a score of minus 44, which is a significant and quite extreme short INR position. And that might explain why there was quite a marked reaction yesterday, if we did see intervention from the authorities, to why we saw quite a sharp move lower in dollar INR. And so ultimately that could help the currency over the medium term if eventually we do see India potentially avoiding tariffs. That could be a medium term support if those positions eventually do unwind. But tactically in the near term, we see risks that we could see some slight further drift higher still.
Parisha Saimbi, good to have you with us. Global markets, foreign exchange and local market strategies for Asia at BNP Paribas. We have more to come. This is Bloomberg.
All right, let's take a look at some of the key commodities we're watching, tracking at the moment. We've got a slightly softer oil price right now. We did hear from the US EIA saying it sees the global oil surplus hitting 1 million barrels a day next year. That's up from its 800,000 barrel a day surplus prediction just a month ago. Aluminium prices looking softer as well. And we heard from Peter Navarro, senior counselor to President Trump on trade and manufacturing, accusing Australia of, quote, killing the US aluminium market. So that'll be interesting to see how this story unfolds. We've got an iron ore price holding on at $106 a tonne, traded out of Singapore. The materials sector more broadly in Australia right now, a little bit softer, while the ASX itself is flat. Now, left gold to last for a reason. Looking very strong, just holding on below 2,900 an ounce. It's the Bloomberg question of the day, is how far above 3,000 that's going to go. And when you put it in Aussie dollars, it's even more impressive at about 4,500 an ounce. And Australia's third largest listed ASX gold miner reported record net profit, unsurprisingly, for the first half year. For more on this, let's get to Lawrie Conway, Managing Director and CEO of Evolution Mining. Lawrie, you must be very pleased with these results. I think you've had a near quadrupling of profit. The dividends almost, well, more than tripling as well. I just wondered, to what degree has a weak Australian dollar really given you a tailwind here?
Yeah, morning, Paul and Shery. Great to be with you. Yeah, I think when we look at it, when we started the financial year and put guidance out, The Australian dollar gold price was trading just about $1,000 or 25% below where it is today. And the Aussie dollar was certainly a lot stronger than where it is today at 62, 63 cents. So we've seen a lot of tailwinds both in the US dollar and the Australian dollar gold price, which, as you indicated, saw our cash flows were up 420% to 273 million, profit up 110%. And that enabled us to lift our dividend to 7 cents per share, 250% up on our interim dividend 12 months ago. So certainly we're seeing very good markets for gold at the moment, and any gold miner who's not making money today probably shouldn't be in gold.
Yes, so you've lifted the dividend. Do you have any other plans for the funds that you're bringing in at the moment? Are you looking at maybe buybacks or capex plans? Can you tell us a little bit about that?
I think we've been pretty consistent around our dividend strategy is targeting paying 50% of our group cash flows out as dividends, and that's what's seen the increase in our interim dividend as we go into the second half of the year. The gold price is trading, $700-800 an ounce higher than what we achieved in the first half. So on delivering our plan in the second half, that would mean we've got more capacity to pay more dividends in the second half. The balance sheet is in excellent shape. We've gone from gearing of 33% down to below 25%, just on 23% at the halfway mark. So we'll continue to delever to get below 20% by the end of the year. And the real fortunate thing, we've got every one of the assets in our portfolio have got organic growth options that we can invest in over the next few years to either extend our mine life or increase production. We've got an average mine life of 18 years in the portfolio, and every one of those assets have got investment opportunities, and that's where we'll also be putting that spare cash as well.
Lawrie, when it comes to the gold price itself, where are you expecting it to go given the tailwinds as it's provided for your business? And what do you think is the China variable here too? We heard that Beijing is allowing some insurance companies to also divest some of their assets into gold and invest in gold. What that means when they're also trying to really veer away from the US dollar with geopolitical tensions rising.
Yeah, look, it's a good question, Shery. I mean, I can't predict where it's going to go. I mean, as I said, when we put our guidance out in August, the gold price has gone up nearly $1,000 an ounce, 25%. When you look at it, even in the last month or so, it's risen, and it's risen as gold demand, certainly into COMEX in the US, people are buying it as safe haven. And I think as you look at central banks as well buying it, you mentioned about insurance companies being able to put assets into gold. All of that to us says it's very good for a gold mining company, because I think there's more upside than there is downside in the near term on gold. And that's something that's important to us to be delivering to our plan in this environment, because it means we're actually able to bank the benefits of this gold price environment. So in short, it won't continue to go up forever, but I do see the near term seeing gold continue to rise and have some good tailwinds.
And when it comes to your mining expansion, for example, the Mungari mill as well, you're expected to complete that ahead of schedule. How much are you expecting this to affect your operations and also impact on your cash flow?
Yeah, the Mungari project, where we're expanding from 2 million tonnes to 4.2 million tonnes per annum, it'll take Mungari's production up from 130 to 200,000 ounces, at least for the first 5 years post-commissioning, and we'll commission that by the end of June this year. So from next year, it's a perfect time for a project like this, where you're more than adding 50% of your production in place at a price that, as I said, is around $4,600 an ounce. We'll get lower costs there, and therefore it will be a strong cash contributor to the portfolio from June. So it's perfect for us to be bringing that project on.
You mentioned a minute ago that if you're not making money as a gold miner in this environment, you're doing something wrong. But if we take a look at some of your Canadian assets, they're quality assets, but compared to your Australian ones, they appear to be underperforming. Is there some reason for this?
Yeah, look, Red Lake's been a difficult one that we've had to integrate over the time since we've acquired it in 2020. We think now that it's getting into a good rhythm of really focusing on cash generation rather than trying to target an ounce outcome. And we've seen that over the last 6 months where it's been generating good positive cash for us. It certainly doesn't have the volume and scale of a CATL, North Parks or Ernest Henry, but what we want out of Red Lake is what we've seen in the last 9 months, where it's been consistent on its delivery, and the last 6 months is just actually making cash and putting that into the bank for evolution. So, yeah, it's been a difficult time, but it's certainly something now that we're pleased in the direction that it's heading.
I know CEOs hate to comment on the share price, so I just want to be clear. I'm not asking you to do that, but is there a reason why you feel that gold miners haven't quite kept pace with the acceleration we've seen in the gold price?
Yeah, Paul, I think, when you look at it, we've traditionally not been great custodians of capital. And in rising price environments previously, at the end of those, a lot of that cash was reinvested in the business, not given back as dividends. And so therefore, shareholders are a little bit sceptical around the cash generation of gold miners and what we do with it. What we've been always consistent, this is our 24th consecutive dividend, is making sure that the shareholders are always looked after no matter what the cycle. And we've seen that in the last 6 months as we've generated this strong cash and returning 7 cents per share, up to 50%. If companies can continue to do that, take the benefit of the high gold prices that we're seeing today, put it in the bank and make sure they reward the shareholders, I think you will attract investors back into the space to invest in gold stocks. If we don't demonstrate that discipline, then that's going to be a problem for us. And so for us at Evolution, it is about doing that. Deliver the ounces, sell it at the high price, put it in the bank and give a fair portion back to our shareholders.
Lawrie, before we let you go, I just want to get your views on policy in Australia. We do have an election coming up. Is there any meaningful policy change you'd like to see from the next government, whoever that is, that would be important for your business?
I think for mining, not just gold mining, I think it's important that whichever government comes forward after the federal election gives us a lot more certainty around industrial relations, around environmental and support for mining, because we do mine responsibly. We are trying to reduce our emissions and make a positive impact. I think there's been a shift in this current cycle away from supporting the mining industry. And I think the other thing is that the governments, both state and federal, are not doing enough in terms of education, in providing financing and incentives for universities to attract people into the mining industry and providing it for trades as well. So without that sort of level of investment and commitment going in post this election, it's going to be pretty difficult for mining if we don't have those three aspects well covered.
Lawrie Conway, really good to have you with us with your results, Managing Director and CEO of Evolution Mining. We continue to watch automakers here in Japan. The markets have come back from a holiday, and we've just heard from the Economy Minister Muto now saying that Japan has asked the U.S. to exclude Japanese companies from steel tariffs. Of course, President Trump has announced 25% tariffs on steel and aluminum. We are now seeing Toyota, for example, trading at the lowest levels since December. Mitsubishi Motors also falling almost 3% as we continue to watch different sectors that could be affected by the trade tensions rising globally now. We have more ahead on the Asia trade. This is Bloomberg. Battery maker CATL has filed its application for a jumbo listing in Hong Kong that could be the city's biggest stock offering in 4 years. Let's go to Hong Kong and our China correspondent Mimin Lo. So Mimin, what are we expecting the demand to look like from this deal?
Well, the company has not disclosed the scale and timeline of this deal, so it might be a bit too early to tell. But CATL is a household name that needs no further introduction. It's been listed in Shenzhen, has a market value of about $150 billion. Its share prices has been down about 5% year to date so far, but it was up 68% last year. It had very good results, earnings up as much as 20%, and is on track to hit a new peak in its annual net income. And this is a company that is the leading producer of these EV batteries, accounting for about a third of global shipping, and its runner-up BYD is accounting for just less than half of that, according to a research firm in Seoul. It supplies to the big automakers like Tesla, Stellantis, among others. But bear in mind, though, it has come under fire from U.S.-China trade tensions. It got listed last month onto the Department of Defense's list of companies with alleged ties to the military. So that while that list doesn't actually carry any explicit sanctions, it could have the psychological impact of discouraging U.S. companies from working with this firm. But given the familiarity that people already have with this company, likely to see a pretty solid demand there.
Meanwhile, bubble tea maker Gooming's about to start trading in Hong Kong today. It's already multiple times covered. What are we expecting?
Yes, this is a highly sought-after stock. It is expected to raise about $230 million, even though the company's prospectus say that they were aiming to raise just slightly over $200 million. And already we are seeing a huge interest from retail investors who have been applying for margin financing as much as 550 million Hong Kong dollars. And you can see on the chart there that actually this is a sector that is expected to grow to a $71 billion industry in 3 years, but it's highly competitive, huge price wars and intense sort of promotions going on. And those two companies you see, the bubble tea firms, have actually been lagging behind the benchmark index, the Hang Seng index. By Baida, which listed last April, actually saw a pretty disappointing debut. Prices continue to slide since then, partly because of this weak consumer sentiment just broadly across China. But we did see sentiment picking up over the last couple of weeks. The founder of Gooming is saying his company has a very unique strategy in that they expand very aggressively into the hinterlands and the smaller townships where growth is much faster, and there are less bubble tea companies available in those places. So they're already the second largest in China in terms of sales and number of stores, and we're seeing a lot of interest in this stock so far.
All right, Bloomberg's China correspondent Min Lo there. And stay tuned for the China show, where Gooming Holdings CFO Hailing Meng is going to be joining us to talk about the business outlook in that crowded bubble tea marketplace. All right, well, it is the China Open at the bottom of the next hour. Let's take a look at how futures are shaping up. Modestly positive territory, and that really reflects the session we're seeing in the Asia-Pacific so far. Not a lot of big moves as the market digests those remarks from Jay Powell. Fed in no hurry to lower rates, being patient. That's it from the Asia Trade. Markets coverage continues in a moment.